We're talking about C corporations. Maybe you know them as regular corporations. Hi, Bob Jennings here, trying to discuss this and make it a little clearer for you. Let's make sure we understand how a C corporation or a regular corporation is formed. You have to do this by hiring both an attorney and an accountant in most cases. We really recommend you don't do this yourself. Folks, I've got 30 years of experience as a CPA, and the biggest problems I've encountered in 30 years is people trying to save a couple of bucks and set up their own corporation. Go to an attorney, spend the money. Which brings us to the negative. A corporation does cost more money to set up because there's formalities involved. You have to file papers with the Secretary of State. Generally, your attorney needs to do that for you. Your accountant gets involved. There are certain formalities that each and every state requires. For example, you have to have annual meetings, records, board of director meetings, reports, etc., etc. As you can already tell, a corporation costs a little bit more, not only to start, but also to operate on an annual basis. Okay? You also have to have a separate checking account of the corporation and a separate set of books and records. You're not allowed to mingle your own personal bills in there. If you mingle your own personal accounts in with your corporation, this is known as piercing the corporate veil, and you lose one of the number one advantages of the corporation, which is you don't have any liability in a corporation. You know, your only liability, the distinct advantage of a regular corporation is your only liability is the money you invest. If you pierce the corporate veil by mixing your business and personal with it, you've lost the major advantage of the regular corporation form of business. All right, let's review a couple of other characteristics. I have 10 characteristics to start with on a C corporation. Number one, they're hard to start, hard to stop. You need an attorney and accountant. Number two, a fair amount of formality is required. Annual meetings, reports, board of directors, etc. Number three, you need separate checking and record-keeping systems. Number four, you must have a federal identification number, which your accountant will get for you. Number five, the number one advantage of the C corporation is a very low liability limited to your investment, and a distinct similar advantage is a C corporation does give you the ability to raise more money than you could raise on your own. Most other forms of business, you're limited to how much you can raise. With a C corporation, you may be able to get other investors in the form of stockholders. So there's number five. Number six, the major disadvantage of the C corporation is what we call the double tax system. Let's say at the end of the year, your C corporation has $30,000 of profit. That C corporation is going to pay the IRS $4,500 in federal income tax. If you then take out the remaining $25,500, that's $30,000 of profit minus $4,500 of tax, you will have to pay tax again. That's why we call it a double tax situation. That's the number one disadvantage of the C Corp, is the double tax idea. Now, don't let that dissuade you from choosing a C corporation, because there are some other advantages, and very good accountants will be able to offset some of these disadvantages for you. So number six is the double tax idea, a big negative. Number seven, also a big negative. If your C corporation loses money, you don't get to deduct that loss personally. Even if you have put money into the C corporation to enable it to keep running, you don't get to deduct that loss until that C corporation is shut down and able to go out of business. Number eight. Number nine, you're required to take your money out of a C corporation as a salary. Now, the advantage to the salary is the corporation does get to deduct it. The disadvantage is, A, you have to pay tax on it, and B, you have to pay payroll tax, which, of course, the C corporation has to match. So, number nine, you take your money out of the C corporation as a salary. And number 10, if you want to take additional monies out of a C corporation outside of the salary, maybe to save a little payroll tax, fine, but you're going to have to call that a dividend. And what you need to remember in a C corporation is it's a bad thing. Why? That means that the C corporation made a profit and paid tax. They then paid you out what was left, and you paid tax again. A dividend means double tax. So 10 characteristics of the C corporation: hard to start and stop, formality required, separate checking account and books and records, you need a federal ID number, very low liability and a good ability to raise cash, offset by double tax. Now, we overlooked the one fact, the one other great advantage is the C corporation is the single best entity that there is for fringe benefits. What do I mean? If you've got health insurance and similar benefits you want to pay for yourself, the C Corporation is the single best choice of entities. That's number 6. Number 7, other fringe benefits are there. Number 7 was the health insurance and other fringe benefits. Number 8, the disadvantage of the fact that you cannot deduct any losses the corporation incurs personally. And numbers 9 and 10 on salaries and dividends. As you can see, a C Corporation, a number of advantages, a number of disadvantages. You need to talk to a good advisor to determine what's best for yourself. For further information, please visit our website or call us at the number on the bottom of your screen. Bob Jennings, thanking you again for listening.